Hello, my name is Jordan Wilson. We'll continue our look at investment risk today by considering how standard deviation is used to quantify and objectively measure investment risk. Our objectives today are: 1, to consider how we can analyze very different assets, investments, and different asset classes. That's the apples to oranges debate. How can we bring everything back into a quantifiable, comparable basis? Second, I want to discuss an investing axiom, something that applies in life as well as investing, but it's key to remember as you go forward. Third, we're going to look at standard deviation, which is the de facto tool to help create an apples to apples comparison when you're analyzing different investments. And then finally, we're going to look at a few limitations that exist with standard deviation, because all tools in investing are just tools. They'll create results, but you have to interpret those results. And as we'll see with standard deviation, it's of more use in some situations than in others. So comparing assets. You have $1,000 to invest for 1 year. Your Apple, in this case, is a US government bond. 1 year, trading at par with a 5% coupon. We assume that US government and Canadian government are 100% certain, especially for the short term. They will pay interest and they will repay the principal. So in this case, at 5%, in a year's time, you'll get $1,050 back with 100% certainty. In comparison, you could also invest in an orange. Risco, trading at $10 per common share. The experts, the analysts, their consensus is that Risco will trade at $10.50 by year end. So its expected year-end value will also be $1,050. Two different investments, identical expected returns. Which should you choose? Or which would you choose? Now ask yourself, what happens if the consensus on Risco increased from $10.50 to $12? What if it increased to $16? Or what if it was only $8? Would you be more or less likely to invest in Risco over the government bonds in any of those scenarios? Often you'll see probabilities. 25% probability there'll be an $8 return, 50% $12, 25% $16. Does that scenario make you more or less likely to invest in Risco over the government bonds? So your choice will often reflect your individual risk tolerance. Are you a widow or orphan and prefer the 100% security? Or do you want to take a risk and hopefully get maybe $16 return? So I would say in this case, with the identical return between a risk-less asset and a risky asset, I'd have gone with the government bonds. And that brings us to an investing axiom. Investors are risk averse. And by that, what I mean is that given identical expected returns, investors will always choose the asset with the lower risk. Looking at it from the other direction, given an identical investment risk, investors will always choose the asset with the higher expected return. Now, this is something, again, that we see in life. you go into a bank to get a mortgage or a personal loan. The lower risk people receive lower interest rates. You want to lend your brother-in-law some money. You assess what the probability is that he will repay you on time and with the interest that you agree on. So all these things factor into decision making in life, whether it be investing or just anything. The problem with investing is things are seldom identical. You seldom would see a US government bond having the same expected return as a common share. So it's give and take. It's not just A returns 10%, B returns 10%. You've got to say, oh, okay, different returns. So how do I factor that in? Fixed income is a relatively efficient market. And one example that I remember is I used to fly into the Channel Islands, and you'd look in the newspaper, lots of banks in the Channel Islands, and you can immediately tell who the stronger, more fiscally solid banks were, because on their term deposits or guaranteed investment certificates, the stronger banks were able to offer less interest rate. So if the common going rate on average was 3%, the strong banks that weren't going to fail, that were basically guaranteeing you get your money back, could offer that 3%. The companies or the banks that you couldn't quite be sure of that they'd be around in a year's time, they might offer 5 or 6%. So they have to offer more return to attract money. It's the same concept, say, as betting on a mixed martial arts fight the UFC has. The odds are set to try to attract people to both sides of the equation. So I would never bet on so-and-so in a fight, say a lady against Amanda Nunes. So they have to make the odds very, very attractive to get people to bet on the opponent. And that's the same in, say, fixed income. If I'm looking at US government bonds versus Venezuelan bonds right now, the US government can offer a lot lower rate to get my money as opposed to Venezuela or some of the other countries that have fiscal problems. Equities, it's also kind of efficient, especially the larger companies because there's so many analysts. But there's also a lot more variables with equity companies. Fixed income, does the US government or the Canadian government pay their debts? Yes, no. A company, Apple, maybe Apple's a little too big, but we'll say Apple anyways. Is the iPhone 12, is it going to be a success or not? If it's not, that could impact earnings. What about iPhone 13? What about their next acquisitions? And so on and so forth. There's so many more variables that impact an equity investment over, say, a fixed income. The other thing you find is that even professional analysts seldom concur. When you look at analyst ratings or earnings forecasts, you'll always see a range. You'll seldom, if ever, see all analysts that cover Google or Amazon pick the exact same target price or earnings forecast. The other thing is that your choice in the previous example or going forward will reflect your own risk tolerance. And that's something that if you're a widow and orphan, you would take less for the guarantee. But if you had a chance at the $16 instead of the $10.50 with Risco, there's some people out there that would say, okay, based on my analysis, it's worth that risk. Others might say, no, it's not. And still others might say, even at $12, it's worth the risk. So who you are and your personality and all that stuff that goes into your risk profile will reflect your end decision. That said, it's still useful to objectively quantify investment risk. Come up with an apples to apples comparison. If we wish to compare investments on more of an apples to apples basis, the de facto means of doing so is with standard deviation. Now, I'm not going to get into the actual calculations of standard deviations or variances, but on my website, I've done a few blog posts with a little bit more detail on the calculation side. Or you can Google bell curves, means, normal distributions to find out a little bit more about how the standard deviation is built up. The other aspect in comparing apples to apples tends to be a lot of risk-return ratios, Sharpe, Trainer, Sortino. Those tend to look at the risk-return plus a few other factors to sort of decide how efficient is this investment. For the level of risk, what is its relative return? And they have their limitations, but there are also some uses to them. So if we look at an example, apples to oranges, A has an expected return of 5%. B also has an expected return of 5%. So if you're a widow or orphan or wolf of Wall Street, 5% is 5%. I should be happy with either investment. But if we look at the prior year actual returns, that gives us a slightly different story. A, over the last few years, has shown a returns of 4%, 6, 5, 5, 6, 4. So quite tightly clustered around the average return of 5%. On the other hand, B, it's shown prior year returns of 2%, 12, -4, 15, -3, 8. So in the last 6 years, B has actually lost as an investment. And in 2 of the years as well, it's also had incredibly high returns. So we see a much bigger variance in B. The volatility going from -4 to 15% year to year. Volatility, variance, those drive the standard deviation. Now, a useful piece of standard deviation is that 68% of all returns will lie within one standard deviation of that calculated mean. And 95% will fall within 2 standard deviations. So this is useful because if we look at A again, A has a standard deviation of 0.8. That means that 95% of expected returns should fall between 3.4 and 6.6%. And again, we see that in the actual returns. They sort of go 4 to 6% over the last 6 years. On the other hand, the risk measure, the standard deviation of B, is 7.2. Here, 95% of expected returns should fall between -9.4 and positive 19.4%. Much bigger range. Also the possibility of a loss. So if I'm a widow or orphan, am I more concerned with a nice, safe, secure 5% return per year that may go up to 6.6, may go down to 3.4, but it's pretty certain, and I'm not at risk of a loss for that year. On the other hand, B, you could lose 9.4%. Is that something a widow or orphan desires? Probably not. Conversely, if you're a higher risk seeker, maybe you're enticed by that huge upside, 19.4% versus 6.6 in option A. So part of it is your risk tolerance, your risk profile that'll help you decide which of these two is better. Now in this example, it should be clear that A is the better option. And I'll use Sharpe ratio as a quick example. So the Sharpe ratio kind of looks at excess returns to the level of volatility in an investment. If you have over a 1.0 ratio, that's good. Over 2, very good. And over 3 is excellent. So the higher the Sharpe ratio, the better, as far as the efficiency goes of utilizing the risk to generate return. We see here that A has an excellent Sharpe ratio of 3.75, whereas B is 0.42, so it's not even good. And again, there are limitations to Sharpe or Trainer or Sortino, but we can see here that there's just too much volatility for the level of risk that you get, the level of return that you get in B. So we've managed to turn two different investments with two different levels of risk into more of an apples to apples comparison. Now, there's a few limitations to standard deviation. One, asymmetric payoffs. Standard deviations work very well when there's a normal distribution. That's where results are equally distributed around the mean or the average point, with even tails on both sides. That's your standard, good-looking, bell-shaped curve. Now, in an asymmetric payoff, the tails are skewed. You don't have the normal distribution, and using a standard deviation gives you a poor result. An example would be employee compensation. So you have 100 people in a company. The mean or the average salary is $50,000. Now, of the 100 staff, most likely many of them will earn close to that $50,000. Some will make less, some will make more. But even those making less will earn a minimum level. The junior staff, maybe $10,000, $20,000. So that's the left side of the curve. Now, if the compensation was normally distributed, so we had a nice bell curve, if the low staff make $10,000 or $20,000, you'd expect the senior management to make about $80,000 or $90,000. Creates a similar distance between the mean to the low end and the high end. But in reality, we know that the president and direct subordinates will earn substantially more. In this example, let's just say the president earns $325,000. The three vice presidents earn $225,000 each. In total, 4 people make $1 million. So senior management may be few in number, but they distort the distribution curve in two ways. One, total compensation is $5 million. Yet only 4% of all employees, the president and the 3 VPs, earn 20% of that compensation. So that inflates the overall mean relative to the typical employee. If you eliminated the senior management from the calculation, you would have 96 staff earning $4 million. And that would result in an adjusted mean of only $41,667 per employee. And that's probably a more realistic figure if you're comparing employee averages. At 50,000, there's probably a lot of employees that think I'm underpaid compared to the average, when in fact it's just the senior management that's distorting the curve. Second, the very small number of extremely high value earners will push the far right side of the distribution out. And that creates a skew, in this case a long right-hand tail and a positive skewing of the distribution. So that's an easy example for all of us to understand. In investing, you'll see asymmetric payoffs in things like option strategies, portfolio insurance. So you need to make sure that you have a normal distribution with symmetric payoffs in order to use standard deviation. Secondly, past is not always indicative of the future. In our last example, we saw that there was a 5% return for investment option A, and the past 6 years the results were 6, 4, 5. They're all clustered right around the 5%. But perhaps new management comes in. Old management leaves. Maybe they're better. Maybe they're worse. If they're better, why would I not expect earnings to be up 10% instead of 5? Maybe if they're worse, there'll be losses in the future. Perhaps a competitor comes into the industry. Maybe Apple or Google enters their business world. Suddenly they're at risk. Maybe a patent on one of their processes or products expires. So the past can help, but you also have to look at how things can potentially change going forward and where the at-risk areas are before relying heavily on historic information. There also needs to be a context. So I have two investments. Investment A has a standard deviation of 6. Investment B, 9. Clearly B is the riskier investment. But what if someone tells you then that the expected return on A is 7% and B it's 18%? That 18% is a heck of a lot more than the 7%. On a risk-return efficiency basis, using a Sharpe ratio, A comes in at 0.83, B at 1.78. And as I mentioned before, anything over a 1.0 is good, and a 2.0 is very good. So B is getting up there at a very good ratio. A wouldn't even be considered good. The other thing that we see is that the riskier investment, just based on standard deviation, 95% of the time, B will not suffer an absolute loss. So we see that its risk is 9. 95% of the time, results will fall within 2 standard deviations. So that's 9 times 2 is 18. Its expected return is 18. So in sort of a worst case scenario, 95% of the time, you'll have a return of 0. With A, even though it's less risky, you could potentially have a loss of 5% at a max. 6 times 2 is 12. 7. So B on a standard deviation basis may be riskier. But if I'm a widow or orphan, I would much rather be in that riskier B. And finally, human behavior. past experiences, emotions, personal situations, investor irrationality. All these things come in and wreak havoc on objective measures like standard deviations. So again, we just saw that in the context. B was a riskier asset than A, but there's a whole bunch of other factors that come in and make B the more attractive investment. And again, we'll see that with your emotions and personalities. Some people will say, I want to do this, that, or the other thing, and standard deviation be darned. Okay, so is this really important? As an investor, do you need to know how to calculate standard deviations? Do you need to know the difference between symmetric and asymmetric payoffs? Do you need to know the difference between Sharpe and Trainer ratios? Not really. But it's more about understanding the underlying principles that makes this important. Or at least I think it's important. I would like to see investors develop more of a systematic process to their portfolios. And I think most people have accidental portfolios. They're piecemeal, they're created from the ground up. You buy some Amazon, somebody tells you buy Facebook, you buy Facebook. And over time you end up with a portfolio of some sort. But I think it's important to step back, understand who you are as an investor, your investor profile. What is your financial situation? What are your prospects? What are your investment and financial objectives? What kind of constraints do you operate under? What's your risk tolerance? How do you perceive risk? All of these sort of things go into who you are and where you should lie on the spectrum between widows and orphans and the wolves of Wall Street. It also helps take a more objective approach to risk, understanding the behavioral finance aspects, biases that you may have emotionally, personality-wise, past experience, understanding what goes into your perceptions and how you identify risk will help you deal with some that you may be able to set aside and take, again, a more objective stance, a more unbiased approach, and that'll help you become a better investor. Understanding investment risk will also help with the risk-return relationship concepts, because it's two sides. On one you have the risk, on the other side you have the return, and they're entirely interrelated. So understanding both risk and return will, again, help you make better decisions, which will help make better portfolios. This kind of stuff also will help when we get into diversification, asset correlations, how asset classes have different risk, both between different asset classes and even within the same asset class itself. Earlier I used an example of US or Canadian government bonds versus Venezuela. Both are government issued bonds, but under current circumstances, the risk of a Venezuelan bond is much, much higher than an American bond. And in fact, it's probably much higher than debt issued by Coca-Cola or General Motors. So even within asset classes, you have different risk profiles. And then drilling down to the investments, we just talked about things like two companies could have the same expected return, but entirely different risk levels. And how you wish to deal with the risk, if you're a widow or orphan or a wolf of Wall Street, you need to understand the risk versus the return to make the better decisions. And finally, I think this is an example of the value of a good or competent financial advisor. Because again, I would not expect you to be able to calculate Sharpe or Trainer ratios, but your advisor should be able to do that. Or, I mean, most of that stuff is already out there. It's just to take the data and analyze it and explain it properly to you. Because I think that a good advisor has to be a partner. It's a partnership. It's not a, I dictate, here's what you need to invest in and here's the timeline. You have to understand, I think, what you're doing and why. I think that's important to all investors. So it's a partnership. You take someone that has expertise in investing or finance, and they are able to explain clearly what they propose, and then the client, the investor, has to be in agreement with that and buy into what's being proposed. Otherwise, you end up with situations where if you don't understand what's going on or you don't agree with going on, you end up with very bad situations and a lot of stress. So that's why I think understanding the basic concepts of investment risk, and when we move on to investment returns, the same thing applies. Understanding the basics will give you a foundation so that when we move into heavier concepts, you can follow along and understand the what's and whys, and not just have someone tell you this is what you need to do. That's all we have for today. Thank you for your time, and all the best.